Obviously, a really interesting day overall. And several reasons why this happened. One, let's just talk about the obvious end of the end of the month, end of the quarter. And obviously, you have window dressing, strong rally. But I think realistically, when I look at this chart, forget about the fact that it's the end of the month, end of a quarter. Think about what's going on here. You have a tight trading range, breakout mode, and you get a really big sell off 57, 58, 59. And while you can look at the sell off and say, wow, that's really strong, it's probably going to go lower. And that's true. It is probably going to go lower. In other words, you're probably going to get a second leg down. However, that is context aside. That's just if we were looking at this chart in general, you'd expect a second leg down. The big problem here is we look at a 60-minute chart. What do you notice? Tight bull channel, trending. It's basically two legs down. Leg one, pull back, leg two. If you were to look at a Globex chart, same thing. Sell off, deep pullback, 2 or 3 legs down. Back to the 5-minute. Looking at the sell off. The issue with these sell offs is risk reward. This is actually a fairly dangerous. Whenever you see a big breakout, you have to be prepared for a possible trap. When you see a big bull bar like 60, that is dangerous, especially when you see follow through. Do you see what happened on 61? Bears sold the close 59, scaled in higher above 60, or on the close of 60. And look where they're getting out. They're getting out at the midpoint of their 2 entries. The close of this bar, the 61 low did not quite reach the 59 close. I don't want to get too carried away with talking about that because we will discuss more of it here in just a few. So let's back up. Monthly chart, strong bull bar. And I say it's a strong bull bar. Bull bar closing on its high. Good for the bulls. But look what's happened. 2 bull bars here, pull back. 3 bull bars, pull back. Bull bar closing on its high. When you look at this, do you really want to buy up here? If you look at this bar, what do you think is more likely? Are we going to go up here to the close of this month to the low of the prior month, the August low? A measured move up takes us to 6,400. Do you think we're gonna go to 6,400 before we pull back? Realistically, we're probably going to try and do the opposite. So if I had to guess, I think we're probably going more down here than all the way up here. So bull bars, but lots of overlap. Weekly chart. I still think this week is going to probably do something disappointing. We have 3 consecutive bull bars, and we have a bull inside bar, and we have a bull inside bar here, but we have a large bull inside bar right here, and that makes me think we're probably going to test the high of the signal bar. If you're a bear, you're looking at that and saying, yeah, it's a surprise. It's a big bear bar. It should get a second leg down, and then you get a reversal up here. Bears sell to close, they sell more higher, or they sell more higher. And what happens? They get trapped 2 bars later or 3 bars later. And what are those bears going to do that sold the high of September 13th? They scaled in higher. They're probably going to be interested in getting out break even because traders are concerned we may get a small second leg up. I think overall we're evolving into a trading range. Channels are trading ranges. Even though you do not see the completion of the trading range yet, a channel is the first structure of a trading range. We have a spike, pullback, channel phase, and at some point we're going to look back and say, yeah, this was obviously a channel, and this was a trading range, and we'll test this low. Maybe we'll come down here. I don't know how fast. I don't know. As far as going to 5,000, we probably will at some point, but again, it's pretty far away, and that could take years and years and years. Daily chart. We sold off, broke below the inside bar, and reversed. Why? Because we're in a tight bull channel. We'll probably get down to the 20 period moving average, this blue line. We'll probably test the breakout point of August over the next several weeks. But looking at the daily chart, this channel's tight. And because the channel is tight, that increases the probability that the market's going to have to go sideways for several bars. So, as far as hoping for a downside breakout, this could go on for a lot of bars. But I do think we had a strong sell off here, strong rally, bears that sold here, and they sell more higher, especially once it starts going sideways. I suspect they'll be able to avoid a loss. And so we'll probably get back to this area over the next several months. Five-minute chart. Beginning of every day, always mark the low of the prior day, which is here, and the high. Low of the day, high of the day. Obviously, the prior day is the prior trading day, in this case, last Friday. And on the open, we gapped down and reversed up. The gap was small. Odds were it was going to close. Plus, if we just look at the Globex chart, just go to a 60-minute chart, easier to see. 60-minute chart, we were going sideways to down for the past few days. We're at the bottom of the range, and on the open, let me do it with the 15 and make it easier. So here is there it is. This is 6:15 Central Time. And therefore, here is 8:15. So the market opens in 15 minutes at this point. And if you look at this chart, we have a spike, pullback channel, but a lot of overlapping bars. Big bull bar here, rally here, bull bars here, bull bar here. All of those reasons increase the probability that we're probably going to reverse up and form an overall trading range. So at some point, I suspect we're going to try and break to the upside. So anyways, to this point, we have a big, I'll show the slide later, big outside up bar. It's easy to look at that bar and say, yeah, that's going to be a strong reversal up. And the reality is, that's a good bar, but that's bad follow through. And whenever you see these really big outside up bars, they're mostly trading range bars, and that increases the risk that we go sideways. This is not obviously the US session, but it's just important to realize that when you see a big bar and then we channel and then you get another bull breakout, that is a very dangerous area to be trading. And that was obviously yesterday's 5-minute during the Globex session, which was over here. Anyways, you get the point. First bar of the day, we have a bull bar with a decent tail above the bar. It's an okay swing buy, even though it's got a tail. Probably maybe 30% chance it's the low of the day, with it being a bull bar. Tight bear channel. Ideally, it'd be better for the bulls if we get a strong upside breakout. 2, follow through, but a close below yesterday's bar 1 high and a close below the midpoint increases the probability that while we will get a second leg up, the odds are we'll get a second leg up. We'll probably be in a trading range. Really not what you want to see if you're buying the close of 1. The other thing to think about is when you're buying the close of bar 1, you're betting against a trading range on the open. So whenever you're buying the breakout immediately on the open, you're hoping that you're getting a trend from the open. And realistically, most of the time, you get a trading range open. So you're going against what is typical. And therefore, if a lot of traders buy the close of bar 1 and then the bar 2 or bar 3 is disappointing, they'll be quick to scalp out because they understand. And when I say scalp out, they'll be quick to exit the trade because they know the odds are it's probably going to lead to sideways trading. Bar 2, it's a bad sell, low in a trading range, probably buyers below and buyers below 1, 3. It's a bad stop entry buy, so I suspect sellers above 3, although we may have to go above the 2 high. And the bulls allowing the bulls to get a second leg up. 4, breakout pullback buy, but a 2-bar tight trading range, inside bar with 3. It's a triangle. We'll probably get a second leg up, but really not what you want to see. And then 5, outside down, probably buyers below. It's possible the sideways trading from 2 to 5 is a pullback, and bar 1 is a breakout. These 4 bars are a pullback, and then we get a second leg up later on. 6 consecutive bear bars, trying to break out below the bottom of the trading range and reverse the bar 1 breakout, but we're still above the bar 1 high. Consecutive bear bars, 5 and 6, probably going to get at least a small second leg down. But selling 5 and 6 is really selling bad risk reward. You're selling the close of 6, maybe stop above 5, and 1 times your risk is all the way down here, and it's really not ideal. Same problem with buying the close of 1. You can buy 1 and put a stop up here, but I don't think the probability is good enough. And therefore, if you're a bull buying the close of 1, stop below 2, you're hoping for a bull trend, and you'll probably add on as the trend becomes clear. If you're selling below 5, selling the close of 6, stop above 5 or stop above 2, you're hoping for a bear trend, and therefore you're probably trading small, and you're willing to add to the position as the trade gets bigger or as the trend becomes underway. We're making lower highs and lower lows, so it's still in a bear trend, but because of the buying pressure here, especially the buying pressure here and the buying pressure on the open, I suspect we're probably not going all the way down here. And we'll probably get up to the 66 area before we get all the way down here. 7, doji, sellers above, and we'll probably get a small second leg down after 5 and 6, but I suspect buyers below the 7 low and the 1 low. 8, consecutive bull bars, but there might be sellers above 8. Not really a good buy area. Disappointed bulls at the 1 close here. Buying more lower, getting out break even. Close of bar 1, 87 even. High of this bar, 87 even, 86.75. So it's testing that bar 1 close price level, which you can see right there. 9, bear bar closing on its low, bottom of a tight trading range. Limit order trading, probably buyers below, but I suspect we'll probably fall below the 1 low. 10, consecutive bear bars, good for the bears, but we had a sell off on 3, rally, sell off on 7, rally, sell off on 10. It's possible this is a wedge, 3, 7, 10, or 11, somewhere in there. 11, 3 consecutive bear bars and a 4-bar bear micro channel, but overlap on 9, overlap on 10, overlap on 11. So it's really not a strong bear breakout, and therefore probably buyers below 11, scaling in lower. 12, outside down, failed breakout below 1, failed breakout below 7. You can call 1 and 7 a double bottom, and therefore 12 is a failed breakout of a double bottom and reversal up. Therefore, it's a wedge. Whenever you see a wedge is 3 pushes, and it doesn't always have to look perfect. If you get a double bottom and you fail it, if you break below it and fail and reverse, it'll always be a wedge. 12, it's a good bull bar. But do you remember what I pointed out? Remember what I said over here? This is a good bull bar as well. Whenever you get a big bar, you know it's giving you big risk. And whenever you see a big bar below the moving average in an overall tight bear channel, it's a more dangerous trade. And therefore, you will have traders, rather than buying the close, waiting for a strong breakout. 13, consecutive bull bars. First bar above the moving average in a lot of bars. Tail above 13. Probably strong enough, 12 and 13, that we'll get a second leg up. But what do you notice? We have the high of 2 and the high of 13. We're pulling back just under the 2 high. And that's a warning that this breakout is not as strong as it could be. 14, we rallied and then pulled back. Realistically, actually, we sold off and then rallied. So 14, it's a pullback, but it's also it's a pullback for the bulls. So we sold off and then we rallied to a new high. Some bulls, when they see a bar like 13, a lot of times, instead of buying the close, especially since it's high in the trading range, they'll try and buy the midpoint of the bar or the high of bar 12, knowing that there's trapped limit order bears who sell the high of 12, being an outside bar, scaling in higher, and they're trapped into a bad trade. And because limit order traders typically can avoid a loss, that causes Trend traders hoping for a second leg after the bull breakout to buy a pullback instead of buy the close. And that's why that bar formed. But 14 overlapping 13 increases the odds that we're probably going to pull back soon. 15 bear bar, probably buyers below scaling and lower. 16 breaking above 15. High one buy above 15, probably sellers above, but also buyers below. Whenever you get a high one, usually the expectation is a pullback and then an attempt at trend resumption. The issue with buying above 15 is that 15 is forcing traders to buy relatively high in a trading range. But we have a micro channel from 12 to 16 and a wedge 3, 6, 12. It's also nested within a larger wedge. One of these pushes, maybe a push here, 33, 61, and then one of these lows down here. It's not perfect, but it works. Or you could say the wedge is right here with 61, bar 1 today, 61 on Friday, bar 1 today, bar 12 from the prior day. So odds are we'll probably get a second leg up. I didn't mean to show all the bars there. Oh, that's why. 16 bull bar, but probably sellers above 15. And then 17 a bear bar. But like I said, sellers above the high one, buyers below. Strong enough rally, probably buyers below. Although we may have to test down to the midpoint of the 12 low to the 16 high before we get a second leg. 18 bear bar, but overlap not ideal. And then 19 bull breakout, but possible wedge. 14, 16, 19 increases the odds that there might be more traders selling the close of 19 rather than buying it. 20 outside down, good for the bears. Strong enough breakout will probably get at least a small second leg down. Anyways, let me get a sip of water here. Lost my train of thought for a second. So we had a bull bar on 19, and it's a wedge. 1, 2, 3. Probably sellers above. So a lot of traders, what will they do? They'll sell the close in 19, and they'll put a stop, a measured move up above the bar. So they'll sell it, put a stop up here, betting on 2 legs down. 20 outside down, good for the bears. Second leg down likely, and I suspect we'll probably test the 12 high and the 11 high. These are bad buy signal. This is it's not really a great buy, especially since we're in a trading range. 21, strong enough bar that it's disappointing for the bears. Because we have a wedge near the high of a trading range, 21 actually might be a trap. It might trap the bulls into buying high once again. If you're a bear and you sold below 20, do you exit above 21? Getting out above 21 is really not all that ideal of a thing to do. I think most traders who are short below 20 will probably, if they have to pick between exiting above 21 or above 20, I think most of them will get out above 20 because it's possible that if this is a trading range, it's possible we trigger the buy above 21 and then immediately go down. And instead, we broke above the 20 high and reversed down. For the bears, 21 is a strong enough bar. We may get a small second leg up after it. But what do you see here? We're getting a series of highs and a series of lows. It's an expanding triangle. And therefore, if you're buying below 22, it's actually fairly dangerous because it's a possible wedge, which means that 21 and 22 might be an implied third leg up. 23, micro double top inside bar, probably traders. I think it's best for bulls to exit at this point. Too much risk to reverse down. 24, we tried to reverse down, and then we got a bull bar. Another breakout pullback buy, high one. But if you're a bull and you bought above 19, you bought above 21, you have yet to make any money. And buying above 24 is actually a worse looking stop entry bar. So there might be more traders selling above 24 than buying it. Plus 24 broke below 23. And that increases the risk of it gets a second leg down. So that increases the risk that there's sellers above 24. 25 outside down, another strong bear bar, always in bears. I would certainly get out below 25. Too much risk we get a second leg down. 26, good follow through, consecutive bear bars. But again, expanding triangle. We have lots of sell climaxes with big bars. And as good as 26 is, the risk for the bears is it's a possible higher low major trend reversal. So the bulls, they see a left shoulder head, they want to sell off and either a double bottom for the right shoulder or a failed breakout and reversal up. Selling the close of 26 is also bad risk reward, so it's a little bit dangerous. And then you can see what happened on 27. As soon as 27 reached the 13 high, maybe it went a tick or two below, it reversed up. Why is that? You can also argue that it went a little bit more than one times the risk for the bears selling on a stop below this bar. So if they sell on a stop, you can see if they sell one tick below, stops one tick above, the market basically went down for one arm. This sell-off's actually climactic too. It's hard to see it, but you have a good bear bar, good follow-through bar, but a tail. And then look right here. This bar, it's hard to see it, but this bar was likely climactic. And therefore, if we go to a 1 minute chart, 1040 to 1045, there you go. That's wrong bar. Here it is. So 1040 is right here. And what do you notice? This bar here, 1041, was the first 1 minute of this 5 minute bar right here. So let me just see if I can do it show it like this. Okay, there is the first 5 minute bar of this. And what do you notice? Climactic bar. And then bad follow through on the next 1 minute. Whenever you have two 1 minute bars, if a 5 minute bar obviously is made up of 5 minutes, every minute that goes by is 20% of the duration of the bar. So the first 40% of the bar is a little bit disappointing. Good bear bar, weak follow through, late in a sell off. In other words, this bar sold off for the first minute. That's good. And then in the second minute, it went lower, but then pulled back. That's a warning that traders are taking profits. Think back to over here. A lot of people want me to talk about the sell off. And the reason they want me to talk about the sell off is obviously it was very, very strong and relentless, at least for those three bars. And so if we go to a 1 minute chart and we look at it, see how that looks different? Big bars, pulls back. But what happens? Traders are selling closes. And what do you notice? We have a micro channel from here all the way down to here. So how many bars is that? One. There's a 15 bar bear micro channel on the 1 minute chart. And that is a sign of very strong selling, but it's climactic. So going back to here, selling the close of 26, if you see the sell off happen and then it starts to reverse up, a lot of bears will be quick to get out because the risk is we may try and get a second leg up above 25. Plus, the odds are that we're going to go above one of these major lower highs. So a real target for the bulls is the test of the 66 high at some point today. 27, you can call it a higher low major trend reversal, but 3 bar bear micro channel with two decent bear bars. Not a great bar for the bulls to buy, plus a weak signal bar above 27. So that increases the chances that there might be more sellers above and we have to go sideways. '28 follow through, consecutive bull bars. However, overlap on 27, but strong enough breakout will probably get a second leg up. And then 29 bear bar, probably buyers below. 30 bull bar, and you can see we started drifting up. First target is the test of the 25 high. 31, 32 breakout follow through, but a big tail above. And once again, we're still forming somewhat of an expanding triangle. 31, 32, good for the bulls, but a tail on 32 increases the risk we get a second leg down. 33, breakout to the downside, and then we rallied. So it's a breakout pullback buy, but it's a high one buy, and the bar is really big. In other words, the bar sold off all the way down here and then rallied up here. There might be more sellers above 33 than buyers. 34, we have a bear inside bar, but after a tight bull channel and with a lot of bull bars, only 2 bars from 27 to 34. And that is a sign. So 2 bars out of 7 are bear bars, which means 5 bars out of 7 are bull bars. And that's a sign of strong buying pressure and only 1 bar closing on its low, but really bad context for the bulls. Always in bulls, okay to get out below 34. 35 outside down, good for the bears, but they need to do more. 36, another bear bar, good for the bears. Bad breakout pullback buy above. And you can see 37, more bulls giving up. What about selling 37? It's really not ideal. Better to wait and see. You have some traders selling, but other traders that want higher probability, better to wait and see a stronger breakout. You can see what's happening. Instead of selling the close, traders are selling the pullbacks. So they don't sell 37. They wait for 37 to pull back, and then they sell it betting on a second leg down. 39, breakout below the moving average, possible measuring gap, low of 37 or low of 38. And it looks like we closed it. 40, a bull bar, but a very tight bear channel. Micro channel from 40 to 35, 5 bar bear micro channel. Increases the odds of sellers above. 41, outside down, almost outside down. Breakout, pullback, sell, but I suspect we're going to fall below 40. And then 42, an inside bar, breakout mode. Looks like we may go a little bit lower. 43, consecutive bear bars. Good for the bears. Traders that are selling it have to be prepared for a deep pullback, but the sell off to 43 is strong enough that we'll probably get a second leg down. And then 44, doji, looks like a bear leg in a trading range and looks like we'll probably pull back soon. But we may have to get 2 legs down, sell off, pause, second leg down. 45, strong bear bar, but as far as selling it, you're selling pretty low in the range, and it's climactic after a series of sell climaxes here, here, and then here. And the final sell climax, 41 to 45, is a little bit of a parabolic wedge. 41, 43, and then 45. So 45 might be a better buy the closed bar than sell the closed bar. But a lot of traders will be hesitant to buy it because it's a micro channel from 41 to 45. Probably strong enough breakout 45 for a second leg down. 46, bull bar. What about buying above it? Tight bear channel. I would not buy above 46. And then 47, a weak entry bar. More traders. You have traders that are hesitant. Some bulls, let me back up. Some bears, they'll look at 45 as being a strong bear micro channel. And because of that, rather than selling, they'll want to sell above the first pullback. But since 46 is a bull inside bar, a lot of traders instead will sell above the first bear bar, especially if it's a big bear bar closing up here. A big bear bar closing on its low. And therefore, they'll sell above 45 rather than 44. Consecutive bull bars, you may get a second leg up, but I suspect we'll have to fall below 45. And then 48, bear bar. But after consecutive bull bars, more traders buying 48. 49, bad breakout, pullback, sell. Probably buyers below. But again, I suspect we'll fall below the 45 low. And then we tried to get an endless pullback from 49 to 53. Good for the bulls. But what do you notice about the pullback? It's really not ideal. You have a bull bar 49, overlap 50. Bull bar 51, overlap 52. Bull bar 53. It's a little bit of a parabolic wedge. Rally, pause, rally. It's actually not exactly true. It is parabolic wedge. We rallied 49, pulled back 49 or 50. We rallied on 51, pulled back on 52, and then we rallied on 52 and 53, and we're pulling back on 53. So if 54 starts to sell off, that could be a parabolic wedge. And instead, 54, we tried to get a bull breakout of the bear flag. 54 is a big bar, but it's a big outside up bar, and therefore it's a dangerous bar to buy. Increases the chances that 54 might be a better sell the closed bar, especially after the tight bear channel. So you'll have some traders selling the close of 54, putting a stop somewhere up here, betting that they can get twice their risk. Or at a minimum, they'll get 1 times their initial risk. So they sell the close. Obviously, they got twice their risk. Inside bar 55, not a great sell, but trapping the bears, trapping the bulls, buying, hoping for the upside breakout. 56, bear breakout below 55, pulling back, testing the 55 low. Not a great breakout, but it's a bad buy signal bar, and there's trapped bulls, bulls who bought up here scaling in. So we'll probably get a second leg down. We're so close to the open of the day that we may have to test it again. And then 57, we got a fairly strong breakout bar. Strong bar with good momentum, possible measuring gap, increase the chances that we get some kind of measured move, and we go lower. And then what do you see on the next bar? 58. 58, as soon as 57 closed, everybody hit sell the market. 57 was the close of 57 is 81 even, and you can see the high of the next bar, 81 even. So if you tried to sell on a limit order on the close of 57, you would have never got filled unless you sold at the market. 58, strong bear bar, strong enough breakout bar. We're probably going to go at least a little bit lower. And you can see 58 actually went 1 times the range down. The interesting thing about 58 is it closed on its high, it opened on its high and closed on its low. So that's a very strong trend bar. And you know you're going to get a second leg down, or at least go a little bit lower. 59, another strong bear bar, good bar for the bears. But with the tail on the bar, I think a lot of traders will exit if we get a bull bar closing on its high. What about selling the close? You can, but you have to ask yourself about risk reward. Plus, the context really isn't great for a breakout here. The more you understand about higher time frame context, the easier it can be. But think about it from this perspective. Here's a 240-minute chart. Or better yet, let's go to a 30-minute chart. Remember, markets are fractal, so it doesn't really matter the time frame. What matters is understanding the context. Here's the context. Look here. We sold off, rallied, and we have 2 or 3 legs down. So maybe 1, 2. So you can basically call it a spike. We have a spike pullback channel. And measure move. We basically reached that. So the measure move target 56.75. Low of this bar, 56.25. What else do you notice? We have a very big bar, and that's a dangerous bar. Increases the risk that there's more traders buying the close of this bar than selling it. Also, look to the left. Here's this low. Here's this low. We came near the low of this bar. We didn't quite reach it. We broke below this bar. So the point is, a lot of trading range price action. And that increases the risk that this is actually a bad breakout that leads to a reversal. It's kind of the opposite. Let me do this. For those of you that were at Orlando, I want to share something that Ali was talking about during the trading day. And one thing he mentioned, this was one of the trading days in Orlando. This was June the 4th of 2024. And you have consecutive strong bull bars. And you look at it and you think, wow, that's a really strong breakout. Of course you buy the close. Well, it's actually still dangerous to buy the close. We have a rally, sideways trading, and then we broke out to the upside. But you're breaking out above support. And then look at the higher time frames. So if I go to a 60-minute chart, this is that breakout. We have this big bull bar, deep pullback, and a 2-legged rally, and this is the trading range. That increases the chances that there's actually more sellers up here. Here, look right here. Here's 5/31/24. It's easy to look at this day. A lot of people remember this day. We had the V bottom and then the sharp reversal to the upside. And it's easy to look at that and say, how in the world did that small pullback bear trend reverse? go to a 60-minute chart. And what you'll see is this: consecutive sell climaxes, spike pullback channel, and then higher time frame, tight bull channel. That increased the chances that this sell-off on May 31st was going to lead to buyers if it got too big and a reversal up. So same thing here. The context for the bears is really not all that good. And if you're selling this close, you might be selling a wedge bottom low in an overall trading range. Always in bears, I'd get out above 60. Too much risk, and we get a couple of legs sideways to up. And then 61 consecutive bull bars, breakout follow through. But probably breakout follow through, good for the bulls. Probably going to go at least a little bit higher. Bears who sold 59 and scaled in higher on 60 or the close of 61. They're hoping that they can avoid a loss. But if we get another strong bull bar closing on its high, that will trap the bulls. And then you can see what happened with 62. 3 consecutive bull bars trapping the bulls into a bad trade, trapping the bears into a bad trade. If I said trap the bulls, if we get another bull bar closing on its high here, I meant trap the bears. Big bull bar, trapping the bears, bears selling closes, scaling in. They have to decide what to do. And realistically, they can't hold on to the trade forever. Imagine selling here and scaling in, and you waited until this. You would have taken a punishing loss, and traders aren't going to do that. Bulls on 62, obviously they're going to be buying a pullback, betting that the bears will use any pullback to buy back their shorts. Therefore, bulls will buy and buy lower. 63, 5-bar bull micro channel with a smaller bull body, probably buyers below. 64, a pause, increases the risk that we may have to pull back for a couple of legs. 65, outside up, good for the bulls. But we may have to pull back, big down, big up. And we may have to test near 50% pullback before the bulls get the second leg to the upside. 66, second entry sell. For the bears, you can take the sell for a swing, but because of the rally up here, I would not. You're selling an area where there's probably going to be disappointed bears, and therefore there's already buy zones that are layered down here, and that reduces the chances that the bears are going to make money. 67, a bull bar. What do you notice that happened on 67? If you're a bear and you sold 66 and then 67 started to go down and hesitate, a lot of those traders are going to be quick to buy back their shorts because they know the odds are we're going to get a second leg up. 67, high one buy, maybe sellers above. But if there are sellers above, there's buyers not far below. And that makes selling here a fairly difficult proposition, and better for bulls to be buying and scaling in lower or looking to buy lower. 68, a bull bar, probably going to go sideways, and then we went sideways for a second leg on 69. 70, breaking out, but it's possible we have to go sideways for more bars, maybe leg one, pullback, leg two, and then we get a second leg up. And then ultimately, 71, 72, an inside bar. Bulls got a bull breakout of a triangle with 73, and then it found follow through 74, and then we rallied fairly quickly into the close, forming a leg one. Obviously, we got the leg one, pullback, leg two. We got a measured move from the close of the highest close of the first leg, 65, to the low of 60. And we got a measured move from the open of the close of 59 to the open of 57. So in other words, an opposite. We got the opposite of the bears. Then we went sideways in the close. For stop entries, you can buy above 1, but I mentioned minor reversal. Bears that can sell below 5, but I'd rather be looking to buy at this point. I think we're low in support, and that's really not a good sell after bar 1. And I thought 12 was a reasonable swing buy, betting on the low of the day. And where do the bulls get out? They probably get out below 25, but if they do, they probably buy again above 27 or 28. And bulls, if they're long, they get out below 34. Bears can sell 25, but if they do, they get out above 27 or 28. And then bulls get out below 34. and bears can sell, but it's low probability. And then this sell off selling 45 is a little bit tough. It's a bear break. It's a bear breakout below the wedge bull flag here, but low in the trading range. It's really better at that point to look and sell a pullback. And then bulls, they can buy 49, but not ideal. Whatever rally we get is probably going to be minor. And then bulls, I'd get out below 55 or when 56 closes. And obviously, bears are selling 57, 58. What about selling 59? Selling 59, I would not. If anything, because of the tail on 59, I think it's better to look to sell a pullback. Plus, you see what happened on 60. 60 went down and tested near the 59 low and started to reverse up. So it's forming a possible higher low on a 1 minute chart. Bulls, they can buy 60. And where do they get out? Some might get out below 66, but I don't think they have to. Bears, low probability sell 66, not ideal. And if you sold 66, you have to get out above 69. It's a second entry. Bulls, I realistically would not get out below 66. Then in theory, the bulls could hold long up until the close, somewhere up here. Limit orders, I thought buyers below 2, but sellers above the 4 high. Buyers below 4 scaling in, but you may have to buy more at the 1 low. I thought sellers above 6, sellers above 7 because of the 2-bar bear micro channel, the 2 consecutive bars. 5 and 6, I thought buyers on 10, below 10 or 11. And then I thought buyers on a pullback of 13. I thought sellers above 15, but buyers somewhere below 15. Sellers above 21, sellers above 20. Sellers above 24, but buyers somewhere in this buy zone below 21, below 13, below 14. And then I thought sellers above these bars, but tough to do. And at this point, I thought it was buy below and scaling lower, betting on a second leg up. Buy the close, sell the close. Really no good buy the close, sell the close for the majority of the day. And then obviously 57, 58, really good buy, sell the close bars. And then what about 62? Can you buy it? You can buy the close if you can use the wide stop and scale in. But if I'm buying 62, I'm betting on the second leg up. Otherwise, it's better to wait and buy a pullback. Okay, let me take a look at questions. Okay, question: how do you avoid big losses? Well, really, what that comes into is managing risk. But in order to manage risk, you have to understand what it is you're trying to do. And what I mean by that is you have to understand the premise behind the trade that you're taking. That's one of the reasons why people screw up all the time. They see the market going down 57 and they sell it, but then they can't understand why the market reversed up 60, 61, 62. And that's because what they fail to realize is the sell off on 57 is a possible sell vacuum test of support. And once the market gets there, everybody starts buying. That's why I mentioned over here that sell off we had around 57, 58. Well, look here. Does that look like a really strong, or do you look really desperate to sell down here? Or do you look at that and say, yeah, I don't know, maybe that's a trap, trapping bears into selling low? And the point is, you have to have an expectation behind the trade. One of the reasons and that's one of the reasons why traders screw up. They think they have an idea of what their expectation behind the trade is, but then when it does the opposite, they freeze up and they don't know how to manage the trade. Most traders are better off learning how to trade something really simple, break out in a second leg, or stick to stop entries. The point is, a good measurement you have to think about it from this standpoint. On the open, do you have an actual game plan? Do you actually know what you're trying to accomplish that day? And obviously, trading well, that is obviously a goal, but how do you measure the goal? In other words, how do you, at the end of the day, measure the metrics behind your trading? You measure it based on the performance of following a particular type of plan. And if you don't know what the performance metrics are, then that's dangerous. If you're looking at your trades at the end of the day and you're just measuring the P&L and L and you're using that to judge whether or not you did well today, that's actually a very deceiving thing to do. It's kind of like looking at win rate. Having a high win rate does not mean you have a profitable system or trading strategy long term. High win rate can actually be very deceiving because what it can mean is you're just buying below things and scaling in all the way down and getting out, selling above base things, scaling in and getting out. But if you sell here and you keep scaling in, that's a strong enough rally that on a 60-minute chart, we may get a larger second leg tomorrow. So the point is, you have to know what the expectation is behind the trade. Someone said, was this a V bottom? You can call it a V bottom, but it's really just a failed breakout. V bottoms are I think it's kind of a lazy term. There's so many better ways to describe something. Failed breakout of a bear channel. Here's the bear channel, lower highs, lower lows. Point is, this, sure, it's a V bottom, sold off, rallied. But if you go off that logic, everything's a V bottom and everything's a V top. Here's a V bottom, sold off, rallied on one bar. Here's a V bottom, sold off, rallied. Here's a V top, rally, sold off, rally, sold off. And if you do that, everything becomes a V bottom and a V top. And there's just so much better ways to describe the price action. Question: how do you simplify? I trust I'm in. Let me move this. Question: how do you simplify the complexities of price action context? It is mostly about what the bulls and bears think bar by bar. In that, context can help their edge. Question mark. What's what is important context today? Well, first off, this is the issue that I'm talking about with the prior question earlier. And it's not this individual's fault. It's just the challenge with trading. How do you simplify context? How do you simplify the complexities of price action context? The issue with that is when you think about context, you have to understand. By the way, I've got to look down because my laptop is down here, and that's the only way I can see the question. And the trade station's above where the camera is. But how do you simplify the complexities of price action context? Well, I would start with how do you simplify price action trading? The way you simplify price action trading is you have a simple trading plan or a trading method and you stick to it. And therefore, you have to understand what you're doing. It's kind of like flying a plane. You're not going to go fly a plane. A really good pilot is not going to fly a plane on one day and then then go drive a submarine on the next day. I know it seems like a ridiculous argument, but the point is you have to be very good at understanding one particular thing. It's kind of like if you were flying a crop duster, which is one of those single engine prop planes, and then the very next day, much less reading the manual, you went and tried to go fly a 747. It's not going to work. And that's what people get misguided about with Al. They look at Al and they say, well, Al's looking at a chart and he's placing a bunch of trades. What they fail to remember is since he's been doing this for so long, it's easy and natural for him to look at a chart and just know what the context of the chart is and what's going to happen. And so it's really, if you think about your question, the issue is this: how do you simplify the complexities of price action context? The problem is most people can't keep the context front in mind, and they're unable to look at this chart and understand the context and then develop a trading plan around the context. What they end up doing is they either have trouble identifying the context. They spend too much time trying to identify the context and not knowing what to do. So if you want to clear up the complexities of price action, Think about stop entries and second legs. Only look for wedge bottoms at the bottom of a trading range. Only look for wedge tops at the top of the trading range. Only enter on stop entries. Only trade always in. In general, one of the context filters I use is the moving average. If the market's above or below the moving average for 10 bars, it's probably more trending than not trending. So to this person asking the question, the one thing I would say is when you're thinking, you know, next time you look at a chart, ask yourself, what is your game plan? What's your trading plan? And when I say trading plan, I don't mean you're risking 0.5% every day. You're doing this, you're doing that. What I mean is, can you identify the trades you took and quickly identify if that was in your overall plan, if that was in your rules? Because if I had to guess, you don't know what your plan is. Question: I bought the close of 36 here, got trapped, bought more on a measure move down from 35, from 35 to 36, 37. Okay, so this person, let me get rid of, let's just do this. This person bought the close of 36 here, and they bought more on a measured move from 35, 36, and 37. So they bought more here. And then they said they regretted it, but got out relying on trading range price action to be forgiving. Can you comment on this trade? Yeah, so the person bought the close at 36 and they had the overall right idea. This is a trading range day. So if I buy here and I buy more somewhere way down here, I can probably get out break even. And that is very true. And obviously they got out, I would guess. And if I'd imagine they bought, let's just see. So if you buy the close of 36 here, you buy more on a measured move, they had a little bit of room, but not a lot of room to get out break even. And they said they got out with a small profit after the scaling. Yeah, that's good. The only thing I would say with that is this: think about your risk reward. So you're buying the close of 36, and you got to think about where your target is in the first place. But for me, if I'm buying the close of 36, or they bought the close at 37, not 36, and they bought more measured move down, and they got out a little bit better. They got out a little bit above their original target. The only thing I would say with that is think about what your overall, if you were not going to scale in, think about it like this: if I'm buying the close at 37, and what's the probability I'm going to make 1 times the risk if I don't scale in? One of the things that traders fall into the trap of is they end up using scaling in to fix a bad trade to begin with. So one of the things I always ask myself is, can I justify this trade without scaling in? If I can answer that yes, I'm a lot more willing to scale in because that's going to make the trade even stronger. But if I know I'm buying high in the range and realistically I'm going to probably have to scale in lower to make the trade work, that's really not a good trade because the risk reward is going to be really, really bad. So what I would ask this person, Jack, what I would ask you is, if you're buying the close at 37, where is your stop relative to your target? If it's not a 1-to-1 risk reward trade, or you don't think there's a 60% chance that you can get 1 times your risk, it's usually better to do the opposite. It's kind of like buying up here. You can buy the close of 66 and put a stop all the way down here. But if you do, 1 times your risk is all the way up here. And that's actually a really bad risk reward. Just because you buy here and scale, you can look at it and say, well, if I buy here and scale in, it'll be okay. That's a little bit dangerous of a mentality to have. Scaling in should improve the math behind the trade, but it should not fix the math. If you need scaling in to make the trade work, that is a very dangerous trade. So overall, the way I look at this, as far as buying here, leg 1, maybe leg two, leg three, leg one, leg two, leg three. My issue is you're buying high in a trading range. And you're looking at this channel and saying, yeah, it's a strong enough channel, tight bull channel. We're probably going to get a second leg. But after three consecutive bear bars and a 3-bar micro channel, you're probably going to get a second leg down. And if this is a trading range, we could go all the way down here. Great question. What's the difference between consecutive complex bottoms and a trend channel? Well, it's the same. Consecutive complex bottoms is just basically a series of wedges. It's a series of bottom attempts that keep breaking out, and then it eventually forms a channel. It's the same thing if you really think about it. So if you have a series of bottom attempts, here's a wedge, we broke below it, and then maybe here is a double bottom or a wedge here. We rallied, we broke below it. A series of consecutive complex bottoms is always going to be a trend. A climactic reversal, a climactic sell-off and a reversal is always going to be a trend. How do you usually add when it is in a trading range? I always add in trends in micro double tops and bottoms. Well, again, it's kind of what I talked about with that question earlier about the person asking about buying the close of 37. And if you're going to take the trade, you really have to understand. You've got to understand how the math behind the trade in the first place. So the way I would think about it is most people are too quick to scale in, and they should learn how to make the trade work without scaling in, and then figure out how scaling in can improve the trade. So people get into the habit of this. They buy the close of 33 and they put a stop down here and they just scale in lower rather than first asking themselves, if I buy the close of 33 and I put a stop up here, what's the probability that I'm going to make 1 times the risk? So if you ever look at a trade and you think, there's just no way I would buy here and put a stop down here if I'm not willing to scale in, that is a really dangerous thing to say. And that usually means you're better off doing the opposite. All right, so where do we go tomorrow? 3-bar bear micro channel, big bull bar. I suspect there's probably sellers above and we'll go sideways. It's a strong rally. And that makes me think that it will probably get a second leg to the upside. But we have a breakout pullback buy high in the range. We can easily trigger the buy and have a pullback. And therefore, if we do have a pullback, that would create, if we rally and then pull back 50%, that would take us to below this breakout point here. So overall, I suspect we'll probably have a disappointment day tomorrow. All right, thanks everyone, and I hope everyone has a good rest of their day.